Hi, my name is Ray, and welcome back to another episode of Ray's Investment Clue Book. Today, we're expanding upon our previous video on financial wealth and talk about cash flow generation. So basically, wealth is basically based off of, financial wealth is basically based off of two different sides that you can look at it from. You can look at it from the balance sheet and the income statement. And the balance sheet is basically increasing assets while decreasing liabilities, and basically having that asset be a bigger part of your overall equity. And that's what we stressed upon a lot in our last video. And here we'll talk about how income statement, a second dimension we can look at it from is income statement. Basically, income statement is having a continuous passive cash flow that works for you instead of you constantly having to work for it. So it's basically almost guaranteed cash that you can rely on to continuously flow in. That's the financial wealth from the income statement point of view. So when it comes to continuous cash flow, of course we already know why passive cash flow is very important. It's a way to guarantee almost an income for you without having to work physically. And so cash flow generation, basically it's good for consumption, and the higher income, usually speaking, the higher percentage of your income derives from investment. That's just, as we talked about last time, wealthier families also have higher investments, more assets, less liabilities. And so when it comes to income cash flow, there are two main types. There's basically fixed cash flow, fixed income investments, such as CDs, treasury bonds, municipal bonds, treasury bills, etc. Because these basically are not inflation adjusted. These are fixed on a certain amount, no matter what, every single period. And inflation index, of course, as you might be able to infer, are adjusted for inflation. They are basically more fluid in that sense. For instance, I bonds or Treasury inflation protected securities, which is basically a modified version. And of course, lastly, and perhaps most fundamental, are dividend blue chip stocks. And these dividend blue chip stocks can be a very, very solid part of your foundation of your financial wealth, which we'll expand upon later slides. So, as an example of a fixed income investment, we have CDs, or certificate of deposits. Now, of course, on this graph, if you pay special attention, you'll see that there's a yellow line, that's the effective federal funds rate by the Fed, and the blue line is the 6-month CD secondary market rate. Basically, as you see here, there's almost virtually no difference between the two lines. The federal fund rate almost always basically is extremely close to the 6-month CD secondary market rate. So we can see here, the CD, it's not inflation adjusted, so of course it fluctuates a lot. And as a result, it basically fluctuates with the federal funds rate, meaning it basically fluctuates with the state of inflation and the state of the economy as a whole. So that's an example of fixed income investment, a CD. Now when it comes to dividend income, the important thing to notice here is we are looking at blue chip dividends, blue chip stock dividends. Basically, and the basic standard we have for these type of dividends are basically 20 plus years of consistently increasing dividend payouts and a consistently increasing EPS, or earnings per share, history. And so, and as a result, we need a reasonable dividend payout ratio that is stable and consistent over the long term. That's something that can last long term. And so we see here's an example of AbbVie and Abbott. And so here we see it's because they spun off around between 2010 and 2015. But before that, when they were one company, you can see here there's a consistent, constant increase in the dividend payout history. And this went well over 20 years. And we see here when the companies split into AbbVie and Abbott, we can see here Abbott consistently increased in dividend payouts, and so did AbbVie, basically continuing the same trend. This is what we mean by a true blue chip stock. This is almost guaranteed income for you, because you can basically rely on this dividend, since the dividend's been increasing every period, every quarter for the last 20 plus 30, almost 30 years now. So you see here's an example of that. Another one is Altria. Altria is a tobacco company, and it spun off between 2005 and 2010 into Philip Morris and Altria. And so Altria here is basically the same thing. It's had consistently increasing dividend payouts that basically always went up, and there's basically no decrease in there, almost no decrease, from around the mid 1980s to 2008 or so. And after it spun off, we can see here AbbVie consistently still increases dividend payouts at the same rate almost. So this is another example of a consistently increasing blue chip dividend. So for our final clues, income generation and capital appreciation, just financial wealth in general, there's basically two goals in it from the balance sheet, the income flow, and basically it's increasing assets and having a passive consistent income generation. And so rich income generation instruments, basically these are always attractive investments because they're consistently provide a guaranteed income for you at a consistently increasing rate. Thank you. See you next time.